George started out as a buyer of mine, and he had his own accounting firm. I had been using my same accountant for like 15 years, and George and I hit it off pretty well during the transactions. And then over the years, he was referring me a number of his clients, and he really helped strategize with his clients for buying real estate. And just the way he communicated and like how much he went above and beyond for his clients, I ended up switching. We switched our he does our taxes now. He helped us set up an S Corp for the rental properties that we have, and that gives us the ability to write off tax deductions where for a lot of people on the call, George, are real estate agents and loan officers. So the real estate agents, they'll be 1099 self-employed, the way they're paid, and then the loan officers, they're all W-2'd at our company. So, I didn't have any tax deductions other than my tithes for church, interest on the house, and the taxes on the house. So George helped us strategize with that. So anyways, he's been awesome resource, awesome referral partner. So I wanted to give him some time to give some of his tips, tricks, advice, so others can benefit from his services as well too, and knowledge.
So yeah, just like Shawn said, we've been working together for like now what, 7, 8 years, almost 9 years. We've been working together, and we've exchanged a lot of experience. And the reason why I'm here, guys, is not to advise you what to do with your taxes or why not. Or I'm not trying here to sell you anything. Trust me, we have more than 400 corporations that do bookkeeping, taxes, as well as personal taxes for the owners. So, but what I would like to stress here, all the horror stories that I see on tax returns and being done, and how people can hurt themselves really badly by trying to take shortcuts or trying to make things like more simple and easy for themselves, and as well as save money on professional fees. But the thing is, what I see a lot, you're just trying to save money from the wrong direction or from the wrong aspect for yourself or for your family. Now, being a real estate agent is very hard. It's very hard job.
Noisy.
So most of the real estate agent, when they get their money, they get it in a form of 1099. Yeah, just like Shawn just mentioned prior. And the problem with that is you just have to report that in your personal taxes in Schedule C. Now, there's 2 issues for that. Number one is it exposes you to audit dramatically. So your chance of getting audited is a lot higher, because you put all your expenses exposed on your 1040. 1040 form is your personal taxes, is the most audited form by the IRS. Now, the second thing is you're paying employment taxes on every single dollar you make. So let us say the top 1% real estate agent who make $600,000 or more a year, right? And then the top 5% makes $250,000 around that area. And then the rest makes under $250,000. Now, let us say you're in somewhere where like you're making $130,000 or $150,000 a year in your real estate work commissions. If you, after you expense all your deductions, if you're in profit, let us say of $80,000, $100,000, $50,000, let's make it $50,000. Right there and then, there's 15% employment taxes that is mandatory that you're gonna have to pay no matter what. So that's $7,500, and I'm talking about plus $50,000. Okay, So that $7,500, nobody can deduct that for you. Nobody can remove that for you. You're gonna pay it no matter what. Now, what I see a lot, but I got a refund. My friend got a refund. How come I'm not getting a refund? But you don't know what else your friend has. Your friend might have 3 kids, right? Your friend might have another business that lost, right? So I get a lot. So how come he got a refund and I didn't get a refund? Now, if he got $1,000, let us say you can profit to $50,000 in your Schedule C, your 1099, and you still got $1,000 refund. That doesn't mean you got $1,000 refund. That means you paid your $7,500 and you paid your income tax, and whatever is left over, you got that $1,000. Now, if you didn't have all the other circumstances that led to that, you will be paying, let us say, 10,000, 11,000, and that's why a lot of people think like, oh, so why my friend got a refund and I did? Now, 70% of the people in general, in the United States, they operate and run their business under their personal taxes. And the IRS loves that because it's right there and then 95% of the audit, it comes from your personal taxes, not from your corporate taxes.
And I would say that's a good point, George, because like a lot of real estate agents that we've done personal loans for, home loans for, like probably you're probably right on, probably about 70% of them just file a Schedule C versus actually creating their own S Corp business and then W-2ing themselves and or receiving a K-1. And there's more benefits to structuring it as an S Corp, right?
Right, that's my next point. Exactly like you said. Those are statistics from the IRS actually comes out like almost every year. So 1.6 to 2.6 out of each, I think 1,000 comes out of audit, comes out of personal taxes, and 0.2% comes out of corporate taxes. Now, and why the IRS catch that is because usually whoever does that does it himself or does it with an accountant that who really don't care or a tax preparer who doesn't care. So you go say, okay, so I used my car, I used my Mercedes, I used my Jeep, I used whatever car I have, Honda, whatever. And here's my mileage. How many miles did you do? 15,000 miles. Okay, reasonable. How much am I gonna have to pay in taxes? You're gonna pay in taxes about $15,000. Oh no, let me increase my mileage because I drove a lot more. How many miles do you have now? 30,000 miles. Yeah, I mean 30,000. Yeah, 30,000 miles. 50,000 miles. That means you drove in the average of 50 miles per hour. You drove almost 1,000 hours a year. You were sitting behind that wheel, claim those deductions. That's an audit, right there and there. Now, the only way to get around this, guys, and the IRS, trust me, they hate it, is to form a corporation. Okay. Now, I get a lot of people say, but I have an LLC. No, you don't. Oh, but I'm registered with the state of Florida, the state of Illinois. You don't have an LLC. You have an LLC with the state. You have an EIN number with the IRS. But when you file your taxes, the sole proprietorship is gonna go under your personal taxes no matter what. So basically, all what you're doing is you're just costing yourself for more money, you're giving yourself for more work, and you're not getting any benefit. Now, when do we get the most benefit out of it? When you take the LLC and you get an S corp status on top of that. That's when you start to play the game right with IRS. Now, when you go file your taxes, you have two tax returns. One corporate taxes that is completely isolated from your personal, and one is your personal taxes, nice and clean. So now when the IRS look at your personal tax return, you're gonna see only one number and one number only. Is your profit or loss from that S corporation. They're not gonna see how many miles did you drive, what car did you drive, how many meals did you eat, how much did you spend on office expenses, or none of that. All what they're gonna see is your profit or loss. So that will reduce your auditing risk dramatically. Now, on top of that, the 15% that we talked about it in the beginning has completely eliminated. It goes down to zero. So that 75, Brittany, I didn't forget about you. I can see you smiling. So that 15% we talked about goes down immediately to zero. Now there is a catch to that. The IRS condition to maintain and obtain your S corp status is to have yourself or somebody on payroll, because they wanted the 15% no matter what. But now when you do your S corporation, you don't know if you're gonna make $100,000 or $150,000, $200,000 or $600,000. So you just have to cut yourself a reasonable salary that matches that income. So if you're making 50,000, the IRS don't know the number. We don't know the number. If anybody tells you what is your reasonable salary for Shawn is different, than George is different than anybody else. Now, get yourself on $12,000, and a third of the income instead of the full income, right? And that's you're gonna pay employment taxes in that, which is good because it's gonna maintain your social security status. So when you're retired, you have social security, Medicare, and unemployment taxes in case you lose your job. You have that waiting for you. But when you're just a sole proprietorship, Schedule C, you're just paying employment taxes on the full amount of the profit.
Does any of that go to Social Security if they're a Schedule C only? Does any of the taxes they pay go to their future Social Security?
Yes, Social Security, Medicare, unemployment taxes, mandatory employment taxes.
That comes out of that 15%.
Yes, that's 15.3%, but you pay the full 15.3% because you're the employer and you're the employee. That case, but when you work, for example, for VanDyk mortgage, VanDyk pays 7.5, and you pay 7.5. So as an employee, a W-2 employee, you don't feel it as bad as 1099 individual who pay the employment taxes in full. Now, let us talk about something else. When you have your own corporation, you can set up a 401k. You can set up a SAB IRA. Self-employment. Okay, now, accounting has three different aspects. I'm going to talk only about two, which is the profit and loss. The Excel sheet, the simple 1099 guy do, write all his expenses, his office, whatever, blah, 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 all these expenses, and go to his accountant, give him $150 or tax preparer, give him $150, or at night jump on TurboTax, plug in all these expenses in, and it's good to go. That's not accounting. And that's you're not doing yourself any favor at that point. First of all, you don't know what the outcome is. And if you do and you don't like it, you cannot do much about it. But when you're an S Corp, you have the back end of accounting, which is the balance sheet, not just the profit and loss. Balance sheet is depreciation, amortization, equity. All this play a role in taxes. Nobody's going to spend the time with you as an individual tax return to talk about all these items and how can they help you or benefit you, right? Your car insurance, your liability insurance, your fees, all this should go under a corporation tax return, not under a personal tax return. And the more you structure yourself as a corporation and you have a separate bank account, that you divide your expenses away from your personal and not mingling all the money together the way the IRS loves it. The more strong your tax return is going to be, less exposure to others, and you're going to pay, I can guarantee you 100% that your tax is going to be probably half of what you should pay. Now, in the W-2s, unfortunately, your hands are more tied unless you are professional real estate, and you guys also qualify for, because you guys are real estate professionals. So whenever you have rental property, you're an active member, you're an active participant. Unless if you're giving the property to a management company, unless if you're handing it out to somebody else to manage it for you, then you're not an active member. But I guess in your cases, you guys, most of the time, if you have one rental property, you're gonna be renting it yourself, writing the lease yourself, collecting the rent yourself, doing the repairs and maintenance, hiring the contractors. So that make you eligible for being an active member, which is gonna offset your being an active member in your rental property. It offsets your income because it converted from a passive income to an earned income. Now, that will lead us to the next point, which is going to help the realtor a lot, the investors. Let us say I'm a realtor and I'm trying to sell a property, John Thomas, and John Thomas has 15 rental properties, right? But I want to sell one more for him, right? And I want to convince him that that's going to help him with taxes. Now, the normal cookie cutter tax return is the property price divided by 27.5 years, and you get your depreciation out of it.
Is somebody that does it on TurboTax or uses like H&R Block, are they necessarily going to know how to do those calculations for depreciation on rental properties?
It should calculate automatically, Shawn, if they do input it correctly.
Yeah, I just see a lot of times, like when people do their own tax returns, like on TurboTax for their rental properties, they'll forget to write off their HOA fees. They'll forget to write off their homeowner's insurance. They'll forget. Like,
well, they don't take, you see a lot of times they won't take or plug in any depreciation, thinking that they're benefiting themselves, and regardless, the IRS is going to hold them accountable when they do sell and dispose of the property. So they're going to get hit worse if they don't depreciate the asset.
Or even have some people that are renting to like a family member and they won't show it on their tax return as rental income. I'm like, hey, by the way, you're actually hurting yourself because you can offset the rent coming in, even if it's a family member, by the depreciation, by the expenses. But yet these people, like, they use like these cheap tax preparers, and like I'll get random tax returns, which, you know, I've sent them over to you to fix them, you know?
Right. And one other point that people miss a lot when they prepare their own tax return or they go to the cheap accountant or tax preparer is a land cost, right? So you have to isolate the land cost from the dwelling. If you don't isolate the land cost from the dwelling, so Don is gonna bought the property for $270,000, $275,000. Went to TurboTax. How much did you buy the property for? $275,000. Depreciated 7.5 years. My depreciation allowance is $10,000 a year. I'm good to go. Boom. Wrong. Audit. You're in trouble. You sit down in front of an IRS officer. He's gonna chew you up and split you in pieces because you should. Land does not get depreciated because even if it was a need or a bond, it's still worth something because it still exists. Now you have to isolate the land cost from the dwelling itself. Now that plays a role in other aspects. Are you going to sell the property soon or not? Because when you sell the property in 3, 4, 5 years, or you're going to keep it a very long term, You should increase your land cost or reduce your land cost. So when you pay back those depreciation deductions, does not hurt your taxes. So that's tax planning. Are you planning on 100 years tax estate company where you're gonna give it to your grandkids, or you're just doing it for the next 5 to 10 years and you're gonna sell everything back? That determine how much you want to put the land cost as, how much you want to take depreciation at. Now, going back to my initial point about John buying that property, other properties, and you as a realtor trying to convince him to buy one more that's going to help him in taxes, John don't care about the $10,000. He want a big bite of his taxes down. He want $100,000. Can that be done? Not in turbo taxes, not on your regular ordinary tax preparer accountant. Okay, that has to be done through cost segregation. Now, you as a realtor, when you go try to convince an investor to buy a property that's going to help him in taxes, he's going to spend maybe $2,000 in cost segregation study, and that will break down the property in pieces. So let us say you're buying that $275,000 property. That roof is not going to stay 27.5 years. That roof is going to have to be redone next year. The carpet that you bought the house with, maximum you can get out of it is 5 feet. The cracked driveway has to be replaced within the next 6 months. All this gonna be accelerated for the initial year when John bought the property, which is gonna put him at $100,000 of loss just in depreciation the first year. And that's what cost segregation is. Now, the normal investors, the normal tax preparer, the normal real estate agent, they just want to sell it. Hey man, it's gonna get you a lot of nice rent. For $1,800, $2,500, the rent is going high. But what he's really looking for is the $100,000 in depreciation deduction to offset his other income, whatever he's doing on the side of that. So cost segregation is very important point for you guys to focus on. It's a little bit costly. It costs about $2,300.
That's just a one-time, that would just be a one-time thing that an investor would do for each specific property, right?
Correct. First year. First, when you buy it, you send somebody down, actually boots on the ground. They go to the property, they break down the items, they write everything, the conditions, and the value of each item, and you catch all this depreciation the first year, and the remainder you divide it on 27.5 minus the land cost. So long story short, I think anyone gets a 1099 to his social security number is very much the IRS loves you, and they want to keep you around because they will audit you, they will take your money, and they are very happy, and they will win. They will win because when you go buy your grocery, it's the same place you're going to buy your office supplies. Same bank account, same receipts, same operation. So when you sit down, they're not gonna take that because you bought pen and paper and computer or whatever on iPad as well as bank. Well, they don't care about that. They will win 90% of the time. But when you have a corporation that has its own bank account and you're separating all these expenses for the corporation away from your personal separate tax return, and then you pay your taxes, you save yourself with the 15%, you depreciate your car, you put your automobile expenses, you put your office supplies, everything you have, that's 100% legit.
And for the loan officers on the call, like, we're all W-2'd. So you had helped us with my wife and I setting up our S Corp for the 3 rental properties we have, and we have the business bank account set up, all the, money comes, all the rent comes into that. We take the mortgage payments out of that. We're able to deduct a portion of like car insurance, gas, cell phone expenses.
Right. So the idea is, again, are you active member in your LLC? Are you active member in your S corporation? Are you maintaining those houses? Are you driving North Carolina, South Carolina, Miami to check on the rental properties? Are you doing Airbnb? Are you doing Verbo? Are you flipping homes? What are you doing exactly? So a lot of moving pieces involve in how you offset this loss or depreciation from all these properties versus your W-2. And this has to be done carefully and correctly. In your case, I isolated all your stuff away from your person. It's a different corporation, different bank account. I don't to go tell the IRS, hey, this person did this much, and he has all these expenses on his 1040. Because very much I'm exposing you. That's what they're gonna be looking at. That's what they look at like 95% of the time, 90% of the time, they look at the 1040. Then they catch your corporation.
George, I have a question for you.
Yes, sir.
Regarding that, and to qualify as a landlord, right, active participant, is there an hour? Is it true that they have to participate the IRS rule of 750 hours annual?
Yes, correct. But most of you guys already are qualified because you guys are realtors and mortgage brokers are participating in some kind of real estate as is, and that's the point. Now, if I have a doctor,
you just made me feel better. I've been doing this for years, so thank you. I wanted confirmation because I always we struggle with if they came and they said, "Hey, you're really doing this 18 hours a week," and I'm like, "Of course I am, right?"
Exactly. Right. So now, if you're a doctor or you're an attorney, that's a situation, but you, of course, involved in the real estate, and that's the purpose of our meeting today. So
we recorded this, right? I've got George here online. Yep, good. Thank you.
So yeah, so if you're involved in real estate, you're doing all your maintenance yourself, you're not hiring a management company to operate for you, all that good stuff, you should be active participant. And now, you're welcome. Now, are they gonna argue it? Can they argue it? There's something you guys have to put in. Let us say you go to an attorney for some kind of, the attorney tells you, no, everything is okay. You don't worry about anything. He didn't make no money, right? The IRS officer, his main job is to make an outcome of the audit, right? So if he don't produce money out of you, he failed. Now, the main idea is to go under the radar. You file your corporate taxes, you file your personal taxes, everything is nice and clean and putting in the correct boxes, and voila, everything is perfect. Now, you're not gonna, to avoid the issue is better than facing the issues. Again, I get a lot of clients who's telling me, but I spended that. This is my right. I spended that. I work from home. Okay, go ahead. Go ahead. Put it. You want me to put it? I'll put it. But when you get that letter and you're going to sit down, you're going to have to prove it. But you're not going to have to prove this only. You're going to have to prove everything else you claim. So come on. When you have the right, don't dig your heels that you have the rights now. Now I got to do it because you're going to have to prove everything else with it. Yes, you bought the computer to use it for real estate. Can you prove the other 30,000 miles that you claimed? Can you prove your office expenses that you claim? Can you prove your legal fees that they are legit? So never ever you're trying to prove you're correct. You always want to avoid to prove anything to the IRS or facing them in any way, shape, or form. You just want to file your taxes nice and clean, go under the radar, pay your dues, and move on to the next year and close the box for this year.
Hey, George, want to make sure I answered this question right. So the one agent on the call said, what if you what if you had an LLC for 10 years? What are the steps to take to set up the S Corp? I said, call George. He can help you set up the S Corp business for you. And he can even put it under the same LLC name after you get the EIN tied to it, the employer identification number. So they can still use their same LLC name, right? And put that on the S Corp.
Yes. It's a Corp, guys, is just a status you obtain from the IRS on top of your LLC. That's all what that is. It converts your filing status from sole proprietor to personal to 1120S, which is a corporation. So yes, if you have an existing, to answer your question, if you have an existing LLC, not convert it to an S Corp, of course you can. And you can do it backward too. You can do it from January 1st, 2020, and do it from January 1st, 2022. You can file your taxes yet. Or if you file your taxes today, there's a provision where you can do it backward as well. And don't ever be scared to file your taxes. It's always a good idea to close the books with the IRS. I get a lot of people who are running for a year or two. Now they want to buy a house. Now I need to do my taxes. Now I have a guy, Shawn, on TurboTax at night, right, Shawn?
Yeah.
And he filed his taxes 2 years prior on TurboTax, right? He dug himself on $100,000 worth of IRS of taxes to buy the house. He closed on the house. Now he want to pay off the $100,000. How are you gonna do that? The IRS will put a lien on your primary home. Oh, but Florida state, you cannot touch the primary residence. But guess what? The IRS is federal. It will override the state. So if the state of Florida saying no, you cannot put a lien against primary residence, well, the IRS will send you a letter, you have a lien out. Or you don't care. And they will sell the house, they will pay the mortgage. The mortgage comes first. If the lien of the mortgage was issued before the IRS, the mortgage will come first, the IRS will come second.
Interesting.
But if he has a lien first, if the IRS has a lien on him and that was not disclosed, guess what? The IRS will foreclose on the house, get their money, and VanDyk will get nothing. Because they are the initial lien holder of the property. And a lot of people, again, they don't know that, they hide that, they lie about that, they want to pay for that. They get all of the scenarios.
So that's why we run like a fraud search to look up to make sure they don't have any liens. So those that have to be tax liens, they have to be satisfied prior to the closing.
Yeah, I wouldn't trust the title search as much. I wouldn't trust the title companies as much because I just have a case right now in my hand in Washington, D.C., actually not here, where they closed. The buyer moved in, and they found out that he has a lien of $100,000 on the property.
Did they do a public record search?
They did everything. They closed. They gave him the keys. The guy moved his furniture, and now they don't know how to dispense the money between the seller who had that lien and the buyer and the mortgage. They don't know between the IRS and the seller. Now they don't know how to distribute the money between the seller and the IRS. They're just in a jam.
Jeez.
So, yeah.
Hey, I want to make sure everybody, so I put George's contact information in the chat. George, is it cool to give your office line or your cell? Is that fine?
Yeah, either or is fine.
Okay. Yeah, so it's in the chat. George's office line, 813-600-3351. or his cell 202-600-6690. And you could also email us and I can get you his info. I mean, like, I appreciate, like, you know, you always being there. Like, I mean, because we're obviously on the loan side, we're dealing with people's tax returns, W-2s all the time. And like, you know, we get all kinds of stuff on people's tax returns. And, you know, now with it being tax season, like for all the agents out there, if you're talking with your, you know, your potential buyers or sellers that are buying, you know, make sure that they're not filing their tax return, especially for the self-employed clients, like before letting a lender take a quick look. I mean, George is great. He'll get me a draft copy of my tax return to review it before he files it. Where we have some of our clients, they're like, I didn't even know what the accountant put on my tax return. I didn't even know. He just did it. He or she just did it, and we got back a huge refund, and that's all we cared about. Well, you know, did you forget that you work at Walmart and they wrote off, you know, $20,000 of vehicle expenses and mileage and
Yeah.
Yeah, so
Because they work the opposite way. Like your expenses work the opposite of taking a mortgage. So usually we try to keep the good balance, me and Shawn, where we don't make the taxpayer pay too much in taxes, but at the same time he will get qualified. Now the IRS will always love to take your money if you want to increase your income. I have no problem with that. But also you don't want to pay too much or screw up your taxes where you dig yourself in a hole and then now you cannot get out of it because you're just trying to buy a house. Do you guys have any questions for me?
yeah, because we usually do this at 30 minutes, but this is awesome. So it's fine that it ran over a little bit. There was one question in the chat: are capital gains for all investment properties, or does that have to be a certain amount of capital gains?
Capital gains, merit filing separate, or I mean, a single is $250,000, $500,000 for couple.
That's in profit.
That's in profit, right?
In profit, yes.
So if you're making less than that in profit, there's no capital gains.
Correct. But what we face a lot is the closing company issue a 1099-S with the seller for absolutely no reason, with the fact that he marked that this was his primary residence, lived in it more than 2 years, and they still issue a 1099, even if the capital gain is, let's say, $70,000. You still issue him a 1099-S for the full selling price, which is wrong. Because if that guy missed that 1099-S from his tax, now he has to file. Now he has to claim the house on his tax, no matter what. Because now he has a 1099 that he has to close it. But it's the title company issued that wrong. Once you file married and your profit is $500,000 or less, you should not get 1099.
That's on a primary residence. What if it would be on an investment property?
Investment property.
Investment all 1099-S. Because
Okay.
you're gonna mark on the closing that was rental property, and the title will mark it as a 1099-S for sure, and he has to put it on.
So you have
like
to show it, right? But
sorry?
there's no you have to show it on your tax return. But if it's less than 250 for single or 500 for married, there's no tax.
There's no tax, but you have to show it.
You have
If
to
they
show it.
issue 1099.
Thank
If they
you.
didn't issue the 1099, you're welcome. And is less than those amounts, you don't have to. Any
That's-
other questions, guys? Brenny, you're too quiet.
Yeah, we have a couple of questions left in the chat. Christina asked, isn't there a difference when a borrower claims rental income on their personal versus their corporate tax returns?
Well, on the loan side of things, you know, we can add back in depreciation if it's on a corporate tax return or if it's on a personal tax return on the qualifying loan side of things. So
Right. What Shawn teached me before is if the rental properties are put in under an S4, you cannot count the rental income. He told me it has to be done under Schedule E. I don't know if that's
Yeah, well, so yeah, so like, you know, for tax purposes, it's going to work out like, you know, works out better for me personally to do the S Corp and for the rental income on there and the expenses. However, for qualification purposes, if I filed them on my personal tax return, it would actually give me more qualifying income. So if you make enough income, like in general, overall, with like, you know, whatever other businesses you have, and like you just need the tax deduction, set up the S Corp. If you're, you know, if you don't have enough income to be able to buy like, you know, another property, then it would work out or for qualification to buy another house if you put on your personal tax return, because then we could count, we could add back in like the interest, the taxes, the insurance that's included in that mortgage payment, add that back into your qualifying income. So, but for tax purposes, I'll let you handle that, George. Is there any difference between doing it on their personal Schedule E or their corporate tax return for the IRS?
Schedule E specifically, I'm not as worried about it as much as the Schedule C, the 1099 NEC. Schedule E is okay, but you just, because you see, guys, the forms are designed differently between the personal taxes and corporate taxes. Corporate taxes has a lot more forms where you can expand your depreciation, expand your amortization. In the personal side, is still okay for Schedule E. I'm okay with that 100%, but you just have to be careful what's the difference between repairs and maintenance. And that's the most of the time I see that repairs and maintenance and depreciation. Okay, when you change the roof for $20,000, that's not repairs and maintenance. That's an asset that has to be added to the value of the house and get depreciated again within the year. So to answer your question for Schedule E, no, I'm not very picky about it as much as Schedule C. Schedule C, I call it Virus C. You want to Virus C, file your taxes under your personal tax.
And you brought up a good point, as George. I had an investor that filed their rental income on their Schedule C because they were Airbnb properties. And you actually confirmed if they were Airbnb properties, that technically is where they're supposed to put them on the Schedule C versus the Schedule E if they're not if they're not like rented out for a certain period of time straight throughout the year.
Correct. So if you rent your rental properties for 7 days or less at the time, basically you become a hotel. You don't become a rental property, you become a business. And business goes under Schedule C. That has to be treated as such.
And then they're opening themselves up to audits there as when they're putting it on. Okay, got it. So setting up an S Corp if they're Airbnbs would be a safer route.
Yes, Airbnb, Verbo, 1099 NEC. You can also throw any other listed miscellaneous income. Let us say if you're doing little jobs on the side and you're getting 1099 for staging, you're getting 1099 for consulting, for helping people out in their transactions, and they want to issue you a 1099. When you have an S corporation and an EIN number, you never ever have to give your social security number out. You just give your company name, you fill up a W-9, has your company name, your company address, and your EIN number. Now, when they issue that 1099, everything goes under this. Away from all that mess we talked about at the beginning.
Another question was, what about the profit on the sale of a personal residence? Does that IRS audit the cost basis of the home a lot or much?
Well, a lot of times what I see is, again, depends. Like, let us say, I mean, keep in mind that the IRS is very aware of the market, is very aware of the economy. Let us say if in scenario as of 2008 and you're claiming loss when you sold your house, of course, it's gonna make sense. Now you're talking about nowadays, if you bought the house in 1988 and now you're selling it right now in 2024, and you think you lost money in capital gain, that's gonna get audited. So the long story short is when you file the capital gain, okay, on your tax return, you don't break down expenses. You bunch them up together in one number. And that's how it works for that. How much you bought the house, all the maintenance and repairs you did in the house, and how much you sold the house.
Realtor commissions, expenses as well too. You can factor in all that stuff.
Legal and professionals, real estate taxes, insurances, everything. But you're gonna recoup the depreciation. You have to recoup the depreciation that you claimed for the prior year. And a lot of people, and that was my first point when we talked about the land cost segregation, how long you want to keep the property. Because if you're gonna sell the property in 5 years, you treat it already for $50,000. That $50,000 is gonna be a capital gain again. So the price that you bought the house, I'm gonna make it simple. The price you bought the house, okay, plus everything you spend on the house, plus you recoup the depreciation. You bought the house for $250,000, you spend $50,000 on the house, and you got depreciation of $50,000. So far, you spent $350,000, $300,000 your cost, and you sold it for $500,000. It's gonna be $550,000 because it's the $500,000 that you sold it for plus the depreciation of $50,000. Gonna be taxable again. So you have to see if your investor is in it for the long run or the short run. If it's in the long run, you wanted the most depreciation. If it's for the short run, when he sell it, he's gonna get hurt badly because all the credit he got, he's gonna pay taxes on it again. But for personal use, none of this exists. How much you bought it, how much you sold it, and is it more than $250,000 or $500,000, and do you have a 1099-S or not, and you do your taxes.
Awesome.
What's that typical break point between short and long run? Is
I
it
would say if it's a 5 to 10 years, I would still consider it. 5 years is short, the 10 years is like middle, and over 10 years is a long run. Keep in mind, a lot of people, they set up a real estate companies, guys, for 300 years plan. We don't know nothing. Those big real estate companies and the investors, they set up 300 years land trust that has a 300-year real estate plan. They never sell the properties, they give it to their kids, they have their grandkids on the land trust, all the trustees, the grantors, everything set up with hundreds of thousands of attorneys. That's like a long-term real estate planning. And that's where the big money comes from. Let's say when you go to South Tampa and you say, oh, that's an old money. That's an old money. That's what this is. Real estate planning for, they go to literally to an attorney and they set up real estate for 200 to 300 years. Any other questions, guys?
That was awesome. All right.
Yeah, great
Yeah.
job, George.
Yeah,
Well,
thank you for your time. Guys, I know, ladies and gentlemen, I know we went way like over our normal, but that was awesome info. So, yeah, again, email us for George's info. I did put it in the chat. Again, he is a good, resource for you, for your clients. It's a great touch for you. Get a hold of them, before they file those 2023 tax returns, just so they're prepared, to buy a house, later this year. So thank you, George. We'll have you on again.
Guys,
So
you.
appreciate it.
Thank you, George.
Happy Friday,
Yeah,
everyone.
we'll have to have you on again.
See y'all.
Yeah, we will. I'll talk to you. Thank you.
Thank you.
Thank you.
Thank you.
Bye. You're welcome, guys. Thank you. Bye.